Hello and welcome to the very first Croatian Private Equity and Venture Capital Association and VentureXchange webinar. How has COVID-19 impacted CEE, private equity markets and valuation? I'm extremely honored to have here with me distinguished speakers from Mazars. Adam Zohry is Senior Associate from Mazars Poland, also spearheading the Central and Eastern European region, and Andrija Garofulic, partners at Mazars Croatia, also in charge for Adria region. So before we start, let me just introduce you to the webinar etiquette. First of all, you are muted as the audience and your chat box is disabled. However, we would encourage all of you to use Q&A tab to suggest questions for the speakers. We'll try to answer as many questions as we can possibly due to the time frame allowed. Also, I would like to encourage you to please participate in the discussion by sharing your comments and view on the social networks. And please do hashtag VentureXchange, CVCA, and VX webinars. If you have any technical issues, please email info@ventureexchange.hr. Before we start, let me quickly introduce our distinguished speakers. Andrija Garofulic is a partner at Financial Advisory Services at Adria region, and he has more than 10 years of industry experience in practice at Croatia. He has been involved in a really broad range of due diligence, valuation, and M&A advisory projects. He is the graduate of University of Zagreb, economics degree with ACCA qualification, and he is a certified Croatian appraiser as well as the court expert for finance and taxes. Adam Zohry is actively engaged in local as well as cross-border financial advisory projects in both Poland and across Central and Eastern European region. He advises clients in many diverse industries, including food and beverage, retail, consumer, automotive, manufacturing, real estate, construction, telecom, and he has experience in a wide range of jurisdictions. Prior to joining Mazars, he's been working at PMP Paribas, which is a feature that we share together. Myself, I'm president of Croatian Private Equity and Venture Capital Association, as well as the director of VentureXchange. Now, let me turn to our first speaker, Adam Zohry, who is going to provide us with the results of private equity survey that Mazars Global Financial Advisory has conducted in June this year. Adam, the floor is yours.
Thank you very much, Mirna. Hello, everybody. Please share with you the main findings of our global survey. Following this, my colleague Andrija Garofulic will present you some facts. So, in response to the ongoing COVID-19 pandemic, our global Mazars financial advisory platform decided at the world level to better understand your challenges, your concerns, and see what will be your strategy responses towards this COVID-19 pandemic. So during 2 months, so May and June, we have been sounding your potential interest for being part of this survey. We had about 140 respondents from all over the world. So some of them coming from Europe, including in CEE. So we had some answers from the Adria region, but also from Warsaw, from Prague, from Budapest. We had also a part outside Europe, some feedbacks from PE funds active in Americas and between 51 and 500 million euro of revenues. And the first series of questions concern the immediate impact of COVID-19 on their business. So we want to first to see what is the impact, the revenues forecast for the portfolio companies of the funds. It's not a surprise, more than 90% of the companies in revenue, 7 and 25%. And here it's quite consistent of funds. But what we notice is that the larger the fund is, generally the more optimistic or the less pessimistic it is, with in average for the larger funds, a drop estimated to less than 10%. Of course, all depends on the sectors of investments of the selected fund. We also asked you and the other funds about your feelings regarding the exit strategies from maturing portfolio companies. Here, about 80% considered that because of the current context, this exit timing might be slightly delayed. Most of them consider that this delay might be between 6 and 12 months. The objective here being to hold positions for longer, hoping that the return on investments will be higher. Concerning the strategy of the funds for the next 12 months, so we saw that it was quite diverse. So about 1/4 of the respondents consider that COVID-19 will not influence at all the strategy. 1/4 consider that they have to focus first on managing downsides because of the current context. And about half of the respondents consider that they will focus on new opportunities, acquisitions, and bolt-ons, the current context. Concerning the deal flow, so here, no surprise, we saw a decline in levels of our activity, which is quite clear among most of the funds. So what we have actually is a situation where funds are much more opportunistic. They are focusing on high quality assets. There is an increased competition in terms of as far as those assets are concerned. So making deals and completing interesting deals is more and more challenging. Concerning those new investments, we asked you if the current the COVID-19 situation will cause you to cease looking at new investments. So the good news for everybody in our ecosystem is that for 3/4 of the respondents, the answer was that, okay, it's business as usual. You continue to look for potential opportunities. And what is even better, that in the short term, actually, you would be interested in making such deals. So there is an appetite to invest. We should remember that just before the crisis, at the world level, PE funds gathered about $2,600 billion of funds. So which are actually still here and which could potentially benefit for the CEE region. Of course, we have a kind of optimism. We have an appetite, but now the question is if this appetite will result in a higher deal volume during the next couple of months. We'll see. We also ask you about distressed and accelerated opportunities to see if you already see such opportunities on the market, and if yes, if you are interested in so more than the half of the funds for the moment do not see a slight increase in such distressed opportunities for the moment. That might be a sign that all the government initiatives throughout the world, and including in CEE region, might have prevented some businesses from insolvency procedures in the short term. But in the middle term, once those shields and financial shields will end it, for sure there will be a higher number of such distressed opportunities. And here we see that more and more investors will be interested in targeting such. Most of us worked in the working from home. during the last couple of months. So we wanted to see if actually it had some consequences on the business. It seems that for most of us, it has been indeed a little bit more challenging than usual, but compared to other businesses, we managed to quite well adapt to the new working environment due to nature, yes, of the financial activity, M&A activity. So completing deals from home is obviously a little bit more challenging. Of course, there was a slowdown in terms of visits of factories from international investors or PE funds. So this might create some delays. But generally speaking, I mean, in terms of IT, at least, we did quite well. And the fact that we have today this webinar shows that actually we are able now with such tools like Zoom, like Teams, to do quite a lot. Concerning the government responses to COVID-19, so here obviously the situation differs depending on the countries. At the global level, PE funds consider that, yeah, for all of them, that they are quite happy of the government responses to the situation. We know that about 1/3 of them consider that it's too early to say, and 1/5 that they are clearly not happy. One thing is sure, we have different feedback depending on the situation of the given countries, even here. Within CEE, the situation might differ between the PE funds active in Poland or in Czech Republic. Government measures. Concerning the business as usual and returning to the normal most of you consider that it, most probably in 2021, that a lot of respondents consider that there could be a second wave of COVID-19. We'll see what will happen in the near future. Concerning the recovery and the economic recovery, most of the respondents, more than 80%, consider that it should be a U-shaped rather than a V-shaped recovery. And we hear more and more economists saying that it could be even in most CEE countries, the more Nike, symbol of Nike, kind of shaped recovery. So a little bit slower even than this shape. Concerning the outlook for the next, speaking, we're quite neutral. I mean, we see a little optimism. At the moment, we are quite careful, but for sure, a couple of weeks and the evolution of the pandemic will help us to have a better view on the next 12 months. So summarizing the main findings of this survey. So obviously, this COVID-19 period was very challenging for PEs. It's hard to do deals when we cannot meet physically, when there are those lockdowns, when there are confinement restrictions. But on the other side, now for a couple of weeks, we have seen a kind of measured optimism from the PE community. There is an appetite to invest in the short term. There will be huge competition for high quality assets, and here the key success factor will be to be able, as a PE, to differentiate yourself from the others and to move quickly to be able to acquire the interesting company you are targeting. That's from my side.
Lovely, thank you so very much. That was really, really very wonderful and absolutely great insights. Now, before I actually ask you some questions, which I would just like to quickly test a little bit the audience and see who do we have here actually in the audience. So if I may ask everybody who is currently hearing us, if you can please choose one of the following options that describes you the best, whether you're a private equity fund manager, a venture capital fund manager, institutional or other investor, bank representative, consultant, or legal or other advisory, corporate, or just other participants. I will like to allow you a few more seconds actually to vote. Please do vote so that we can just quickly see, and I'm going to share the results in a moment. Okay, I think that I'm ready to share the results with everybody. So we see that we have overwhelming proportion of consulting, legal and other advisory participants, about 45%. Approximately equal range of institutional or other investors and corporates, and the private equity fund managers are represented with 9%, with venture capital being 5%, but that type of group jointly together has 14%. And so I would like to now just test a little bit our audience with regards to the sentiment of the audience that we have here today. And I would like to just ask you very quickly the two questions on how are you feeling today? When do you expect that everything is going to return to business as usual? Are we talking about Q2, Q3, Q4, or 2021? I am here obviously repeating the same questions that Mazars used in their survey. And I also want to check out a little bit the level of optimism that you have with the outlook for the next 12 months. Do you feel very pessimistic, neutral, or moderately optimistic, or very optimistic? So let me allow for about 10 more seconds for everybody to have a chance to vote. Please do share your views with us. Okay, and now I can end the poll and share the results with everybody. So overwhelming proportion of our audience here today expects that only next year we'll go back to normal and business as usual. And it is unfortunate that people feel very pessimistic. About 41% feel very, very pessimistic about the next 12 months. But there are some of them, jointly 27%, who would feel moderately optimistic or optimistic. So that's enough for the polls. Now I want to ask Adam some questions regarding the results of the survey. So based on your observations, what are the sectors which suffered the most following COVID-19? And what are the sectors which are now of interest for private equity funds following the pandemic?
So concerning the sectors which are the most impacted, I think that here we all observe that the tourism and hospitality sector has been particularly impacted by this pandemic, and it's still the case in most European countries given the limitations in traveling. So we can probably consider that in terms of deal making, it will have some consequences in the short term. We see also that it's quite connected also to all the transport related sectors. So airlines have a lot of problems, car trucks have a lot of problems, car rental industry, which is very much connected with tourism and hospitality, had some issues. We saw it with the example of Hertz in the US. CEE is a lot dependent on automotive industry. We are very much connected with Western European companies, notably from Germany or France, producing such cars. So all their subcontractors might face some issues, and here PE funds investing in that sector might also review the strategic priorities for and forecast for the next couple of months. We see that based on our discussion with PE funds that investments related to retail might also slow down. In most CEE countries, malls and shopping centers have been closed. So it had direct consequences on the retail industry. The sale of clothes or such brand producing textile. Entertainment and leisure, obviously. I mean, with the fact that there was a lockdown and even after the lockdown, cinemas and other kind of leisure parks suffered a lot, so which in the near future might continue. And of course, all what is related to food services. Here we had in all CEE region, I mean, restaurants which were closed, and still the recovery is quite hard to be seen in that sector, especially that people are still sometimes quite afraid, and we do not know if there will be a second wave. Concerning the opportunities in the healthcare and pharmaceutical sector, for sure, the CEE has plenty to offer to PE funds. We have more and more financial but also strategic investors asking us about potential targets in that sector, looking also for potential alternatives to companies in Western Europe or in Southeast Asia. We had the example of one company willing to find a company in CEE producing some medicine, considering that in Western Europe prices are a little bit too high, that in Asia, given the problems with supply chains and sometimes a problem with quality, CEE could be well positioned for this kind of sector. With the COVID and all the testing industry, which is related to diseases, for sure, we expect a higher interest from PE funds for this kind of industry and biotechnology, IT. We, despite the COVID, we see that, or thanks to the COVID, we see that there is a strengthened interest for that sector, not only from the side of PEs, but also from strategic investors. One example, or actually two examples in Poland. We had Microsoft deciding to invest $1 billion in Poland for the cloud, and Google the week after, who decided to invest $2 billion also in Poland. So we can presume that in the CEE, as we are quite known and skilled in that sector, there will be a growing interest from international funds to invest in IT. And some niche sectors, I will mention only one of them, the gaming industry. It's something where CEE countries are getting better and better. For example, with the Witcher game, we saw that during the lockdown, a lot of consumers actually bought games, and in that industry, the CEE has good skills and potential good targets for PE funds and strategic investor. More generally, we can consider that in the middle term, the CEE could benefit from the COVID, notably with the relocation of some manufacturing and factories from Asia to CEE.
Okay, thank you. And now I want to ask you, Adam, you're based in Poland, which is the home of the largest Central and Eastern European private equity funds. And Andrija, you are actually covering Adria region out of Croatia. So to what extent has this COVID-19 affected the cross-border transactions, because we have many Polish and funds and funds from elsewhere, like database otherwise operating from London or elsewhere, that are investing cross-border and across the region. Do you see a change of behavior, and the people are more looking towards their own national borders? Is the cross-border activity subdued as a result of greater uncertainty?
And of course, there is always a risk aversion, but I think that compared to investors, PE funds are a little bit more keen to take risks when it makes sense and when there is a high quality assets. What we observe is that actually we continue a trend we had just before COVID-19 in Warsaw, that a lot of funds which had already a growing interest for the Adria region are keen to, given the current context, to look for potential new targets, considering that in terms of valuation, it could be even more interesting than before the COVID-19. In Poland, we have indeed a few PE funds with a regional coverage and which are quite active in Adria region. I will mention, for example, enterprise investors, which did several investments in Croatia. For example, in 2018, they acquired Studenac, which was active in the chain of, as a chain of retail shops, supermarkets, and warehouse. So in that time, the revenues of the company was around 200 million euro. They also acquired a producer of baked products and confectionery, so in Croatia, Panpek. We also saw this company active in countries like Slovenia. They acquired, for example, Intersport ISI from Mercator, who wanted actually to focus on its core, and it was an opportunity for this Polish fund. We have other potential funds, other funds which invested in Adria. I would mention, for example, Innova Capital, acquired in 2016 a Slovenian-based company providing steel buildings, roofs, facades, so-called Trimo.
Adam, you're breaking up a little bit, but maybe I can ask the same question to Andrija. Andrija, would you like to just comment quickly?
Yeah, so hello to everybody once again.
Hello.
I would say that
do you hear us?
This moment it's too early to conclude what we can see, what we hear you, Adam, but the quality was bad. So from our perspective, what we see is that the local funds that are raising some specific amounts of money will probably be focused on the Adriatic region and Balkans region. So in Croatia, 6 funds. But in relation to the larger funds, what we see is there is still interest for a specific industry, such as especially IT, that is growing this COVID crisis. I would not expect that something major will change, because there is there is excess liquidity on the market. Maybe funds will be more focused on valuation, more focused on the multiples provided. But I do not expect that major changes will occur, and that something will actually be different than before.
Mm-hmm. Thank you very much. Thank you. And I think now it's time for our second presentation, presented by Andrija Garofulic. Mazars has done a wonderful input on how actually to value companies in the time of crisis, and it is very, very interesting, with valuations shifting all over the place. What do? How do you actually access what is a good and valuable investment opportunity? So Andrija, the floor is yours. Please proceed.
Thank you much. So I think that this is really a hot topic these days, because everybody actually is expecting difficulties in valuation due to the fact that that high uncertainty of I would say of future cash flows companies will actually have and achieve. Today, what we will be discussing is actually how to apply usual business or valuation methods in the terms of new COVID crisis. We will discuss what are the downfalls of income approach, multiples approach, is to come up with something that is I would say a lot and acceptable, and on the other side provides more safety to the all persons that are included in the evaluation per se. The thing is that I would say that value of each business is always linked to the future through DCF, whether through multiple. And now the situation is that forecasts are not so stable and forecasts are not so reliable. But at the end, as in any valuation, we need to accept these limits and live with these limits as we know, and try the best we can to prepare as much precise valuation as possible. Just for me to just a second, cancel. I'm not cancel. So we will be discussing generally about steps for valuation in crisis. We will then discuss about something about a more focused income approach and multiple adjustments as a response to COVID-19. We will be discussing about one of crisis parameters that will enable us to model the crisis and to actually change or to modify the multiples achieved, and to explain the differences in multiples achieved on the market. So starting with initial steps for valuation. In general, I would say that if we try to stick to normal valuation techniques in the times of crisis, we can actually suffer from very different results than expected. We can actually overestimate, or quite easily we can overestimate or underestimate the value of the business, and per se for such reason it is necessary to determine whether what is the context of valuation, and whether in terms of framework available, whether we can adapt our approach to valuation itself. I would say that one of the main problems for sure is the uncertainty of the future events, and as I said, companies not being also market approach, we can conclude is not a good base year to perform a valuation, due to the fact that probably majority of businesses will suffer in 2020. So if we apply some multiples, as we will see after on, to 2020, then we can have a estimation. The potential answer is a multi-criteria approach, meaning combining more than one method and adapting more than one method to just to be able to see whether we can value the business from several different angles, and have the better understanding of the specifics related to the case. The thing is that this multi-criteria approach again is not the perfect solution and does not answer all the questions raised, because in a nutshell, all the methods concerned always have the same problem, and that is actually loss of visibility on the markets. Whether this is a smaller number of transactions, this is valuation methods are impacted on very similar way, meaning that future cash flow is I would say quite unstable. To conclude this slide, we need to understand what is the logic of valuation, what we need to do, what would be methods we need to take, and whether we, in terms of COVID-19, whether we can modify these methods to have a more stable and more better approach to the valuation. When we discuss this, I would say market-based methods, we can conclude, especially from the private equity perspective as well, that the market methods and multiples in general are always a good way forward to value the business. You know, it's kind of we have the good visibility. You compare the peer groups and the transaction taking place in history with the business in place. And although this multiple approach is always connected with the DCF per se, it provides some stability on the market. That Western countries than in Adria region, because in Western countries you have, I would say that you have a majority of peer groups available on the stock exchange and the stock markets, while in the Adria region this is potentially not so easy to do. In general, I would say you always have a request that valuation during crisis and valuation in general should be on a specific day, reflecting the meaning of spot price and taking into account the scenario of normal conditions, meaning not these defined by the current crisis. However, a couple of things need to be taken into the account when doing so, and this is these are listed on the slide, saying a stock market analysis. When we compare some market multiple, we need to take into the account the trading volume of the stock is sufficient to be compared with our case. What are the price volatilities and whether there are any possible reasons for typical trades. The thing is that Mazars study Western countries has shown that liquidity on the stock exchange is sufficient and does not provide explanation for drops in prices. But anyhow, on the other side, this liquidity often seems to be related to the sale in the distress situations. And as such, potentially, you know, although we apply some multiple from the stock market, maybe potentially it would be smart to use some temporary liquidity discount in our valuation methodology. We also need to take into the account recent transactions. So we need to compare the companies that were the subject of specific transaction, but we need to go case by case and see whether in any of these recent transactions, whether the impact on crisis was the event itself, meaning that whether any part of the crisis, such as, I don't know, lack of liquidity, led to actual transaction and sale of the assets. So if we compare our normal case with the recent transaction that was actually taking place due to the liquidity issues, then we can have actually different results. It's always good to use analogical methods, for example, multiplier, and seek to mitigate the effect of price fluctuation by comparing prices over a longer period of time. Of course, this is always difficult in times of crisis, but if we compare the prices over a longer period of time, we will for sure have better results. Also to say that is two main types of risk that to mention them occur for a market-based method and the market in general, and this is temporary risk, and this temporary risk is related to the loss of investing landmarks for the investors, and as investors do not feel safe, then it's quite normal to see the drop in the value of the companies and securities. And on the other side, there is also something that is called residual risk, and this is related to the fact that things maybe will never be the same on the market, and potentially that the companies that were market leaders before the crisis will never reach or will actually lose their market share after the crisis, and this is also something that is influencing the valuation and market-based methods. On the other side, income-based method, it's typically related to the present value of future cash flow, meaning discounted cash flow. The main problem here in terms of crisis is the fact that lots of companies have solid or have big issues preparing reliable business plans. So we know, for example, in our region and from our client base, I can say that probably 80% of the clients are not able to independently prepare a reliable forecast for the forthcoming 5+ years. And this will especially be relevant in the time of crisis when the companies normally focus on liquidity. And when due to the increased risk of future risk, it's very, very hard to prepare a reforecast that are reliable, that can be used for valuation itself. I think that this should be tackled through three different approaches. One is for sure different scenarios. So in DCF, we would for sure seek to build at least 2 or 3 scenarios, meaning worst case scenario, best case scenario, and a normal one, to understand how the combination of these would influence the valuation itself. And the other that can be even have more impact on the valuation would be the adjustment of discount rates and balancing the risk and the reward concept, meaning that we need to include all the risk we have mentioned before to discount rates through the different premiums. I would potentially say whether liquidity premiums or size premiums, to reflect the fact that the valuation is being made during uncertain times. When we combine these two methods, we are discussing about, I would say, hybrid methods. And these multi-criteria methods combine income and market methods. And if we compare this, I would say that we could have a better picture. Namely, when we discuss income approach as before, income approach on a standalone basis has a problem in terms of crisis due to the reliability of the business plan. And on the other side, market approach suffers from volatility of the market and temporary uncertainty that will lead to the distortion of the multiples. That's why our valuation team would for sure go towards the multi-criteria methods, and that actually allow us to treat from the income approach each company as a unique unit and utilize the business plan. But on the other side, we through the combining of income and market methods, we can collect all the data that is available on the market, and we can actually pool what we call collective understanding of available information into our valuation models. Anyhow, we need to always check whether this hybrid methods is allowed under the available evaluation framework, to be able to utilize the potential benefits of this approach. Anyhow, what should be the approach to these multiple adjustments is, as the crisis actually expands, companies, as we said, are focused on the cash and operations in order to maintain liquidity. And in terms of crisis, market multiples actually are under the big, they are very volatile and experience strong changes, and that's for timing seems to be crucial. And it's very important when at one moment are we reviewing a specific market multiple on hand. As it's written, prices tend to fall before the issuance of new forecast, and then once the new forecast is reissued, multiples mechanically rise unless the price evolves again. The thing is that a market multiple derived from the pre-crisis forecast shall not be applied to the reforecast, because if we would apply the market multiple to reforecast, then we would have a situation where we would strongly underestimate the value of the business, and we will be discussing this later on. So depending on the daily information and the issuance of the reforecast, we can always expect the new shifts on the market. I would say that these, as we will see later on, the release of reforecasts and that are usually related to the decreased EBITDA in the reforecasted plan will most often lead to the strong rise of market multiples. And this is the case because each business is valued on the future cash flow basis and not only on the current performance level. So if we have, for example, 2020 multiple that is decreased for 80%, it will not remain 80% decrease for the entire horizon of business plan. And if we would look at the future cash flow and DCF, we would have enterprise value that is, for example, maybe 10 or 15% below the pre-crisis time, and the current EBITDA is 80% below the pre-crisis time. And if we would apply the normal multiple to this revised business plan that is 80% less, we would strongly underestimate the business in question. Yeah. Therefore, I think that there is one key question here is, and we will be discussing this later on again, is whether we can apply or whether it seems reasonable to apply the multiple on, I don't know, second or third year of a business plan, or forecasted business plan, just to avoid the effects. And this is, I would say, the question to the private equity community as well, whether they would feel comfortable to apply the multiple on, I don't know, 2022 or 2021 as a time where we would expect that the business would return. Actually, everything will return to normal as before. So when we look at the multiples and the example here, we will go through the example and see how this we have been discussing will affect the multiples. So we have, in this situation, we have a figure 1 and have a company A that has a pre-crisis EBITDA business plan of 106 and has an enterprise value of 980. So this implies the multiple of 9.2. After the crisis hits, the markets are actually responding with the 18% fall of the enterprise value and market capitalization, 26%. So a new enterprise value is 805. And this leads to decreased implied multiple of 7.6 without any reforecast, this is just, I would say, the answer from the market on the uncertainty of the future cash flows. And once the company would actually issue reforecasted crisis-based business plan with the new updated EBITDA that will amount to 35, the market is still taking into account all future cash flows that will happen, and we can see that enterprise value is 815, meaning that the drop of the enterprise value is not even close to the drop of the crisis business plan EBITDA. And that leads to the strong increase of implied multiples to 23.3. Now, if we would apply this 23.3 multiple to I don't know, to this 35 that is actually crisis EBITDA, we would strongly underestimate the business itself. We have a Q&A, just a second to see.
Don't worry about it.
Okay.
It's for later. It's for Q&A.
Okay.
But we have to wrap it up shortly in terms of the
okay. And on the other side, what we see is the other example, company B, which business plan is going negative to -20, and then we have a negative multiple because again the market and enterprise value is taking into account all the future cash flows. That's why we feel that that we need to have a thorough understanding of the timing of the events. So if you would use like this 23.3 multiple from the listed company A, and if you wouldn't understand that this is actually related to the reforecasting of the business plan, then you would have a completely different result. I would say that this is the reason why we feel that it should be relevant to use again in looking at the listed company A, potentially second year of the business plan, because if we see the crisis business plan in N+2, then we have an EBITDA of 107, and this actually again normalizes the multiple to implied multiple to 7.6. So from our perspective, it would make sense that we use the future 21 or 22 business plan. I will wrap up shortly, Mirna. Just a second, sorry. So looking at what is also important is that when we model the crisis, we need to take into account three different parameters, and this is initial magnitude or intensity of drop of performance. So initial drop of EBITDA in the current year. We need to take into the account duration of the crisis, meaning we need to understand how long the crisis will take place. And we need to understand and combine numbers 3 or 4, whether there will be a possibility of catch-up of this initial drop and returning to the normal plan, or this will be an everlasting shift in the level of demand, meaning that we will just lose a couple of years of performance and we will remain at the lower level. This is important because in each valuation in DCF modeling, we have a couple of in pre-crisis situation, we have a couple of horizons. We have explicit horizon, and this is the usual business plan. And typically it is up to 5 years, and we grow at some constant rate. Then we have implicit horizon in each valuation. This is actually relevant for the terminal value. And we have a growth that is more equal to the stable rate of the growth of the economy. And in the intermediary, we have something that is called smoothing horizon, where we combine explicit growth, high growth in the explicit period to slow growth in the implicit horizon. And we are actually smoothing the results. Now, if we take a look at this slide and we diagnose what will be the parameters emulating the effects of the crisis, and we do the initial pre-crisis modeling, we can combine two of these and actually have I would say, the modeling of the crisis per se. If you look at the graph on the right, we have a initial blue one pre-crisis business plan, and pre-crisis business plan has its own curve. And after that, we have a reforecast. This is a crisis business plan that is orange. Now we can see that there is a strong decline in the performance in the first year, and it will take us up to 3 years or even more, 4 years of recovery period to go back to the initial magnitude of business we have been performing. After that, we have something that we call a catch-up period, if the catch-up occurs. So this is the actually on this graph from year 4 to year 10. This is a period of time in which we need to go back to the initial plan. Or on the other side, if this catch-up doesn't happen, we have something that is called perpetual loss, and we have a perpetual discount due to the fact that the crisis and the volume of performance will always remain decreased. When we take a look at all of these, just to wrap up, we can actually see that all of these planning and understanding of the DCF and the business plan would lead us to calculation of multiple adjustments. These are empirical numbers that were being calculated by our valuation team. And if we take into the account the duration of the crisis, the magnitude of the crisis, and the catch-up assumption, through this table, we can see that, for example, company that has compound annual growth rate of 7% before the crisis and has a discount rate of 9, had a pre-crisis enterprise value multiple of 16.8. Due to the fact that the recovery will take 2 years, this 16.8 will actually be declined for 2.7 multiple due to the fact that the recovery takes 2 years. And again, due to the fact that initial step down was 60%, this should be, and recovery will take 2 years. This multiple will be increased for 0.9. So if we combine these, we will see that 16.8 will actually be decreased for 2.7 plus 0.9, meaning 1.8. We will have 11% decrease as an effect of the crisis. And in each situation and in each peer analysis, we would need to do the calculation of the multiple adjustment and then to apply to our model. I know that we are short on time, so I'll be finishing here.
Okay, that's lovely. That was a very insightful presentation. Maybe you can just stop sharing, Andrija, so that we can each see each other. And I know valuation seems sort of like an expert topic. But just, I want to check a little bit on our audience here, because I know we have a lot of advisors, consultants, private equity practitioners, and investors. If you can just, share with us a little bit your views on what is the general type of valuation techniques that you have been using in general, or that you use in a post-COVID-19 environment. Is it the DCF and income approach? Is it the multiple analysis? Is it the hybrid of the two above, or other, or all of the above? So what is something that you use in general? And then the second and related question, we have now seen an expert analysis for somebody who does valuation on a day-to-day business as a butter, and as a bread and butter. But, I want to ask general participants, what is the type of adjustments that you have been implementing in your valuation plan? Is it something that you would qualify as being a plain vanilla, whether we talk about a permanent or temporary discount? Is it a scenario analysis, revaluation of forecasts, all of the above, or none yet? So please pick one of the choices, and I will give a few more seconds for you to decide what type of valuation techniques are you generally using, as well as in the COVID-19 environment, and what adjustments you have been doing. So it's going to be a little bit interesting to see what our participants have been doing so far to adjust. And I'll close the poll in 5 seconds. So 3, 2 down, 1, okay? And so yes, I'm now sharing the results. So it seems that the majority of participants use the hybrid approach, incorporating both the DCF or the income approach together with the multiple analysis or market method. And in terms of the discounts, it seems that the prevalent choice seems to be the scenario, as well as the revaluation of forecasts, and a little bit of all of the above. So, okay, I haven't shared yet the results, so you can see it a little bit now here. And without maybe just dwelling on the results, we went through the very detailed and expert presentation. I want to ask Andrija a little bit on in general, if you can just summarize in a very single sentence. We went to a really detailed presentation. What would it be? What changes did you make in your valuation practice with regards to COVID-19? Just one single sentence.
I would say that we are always focused on the business itself, but what we are mainly concerned is actually reforecast of the business plan. So we pay much more attention on the business plan itself and the reforecast of the future cash flow. And this is, I would say, that focus on the level of business plan, on the quality of business plan, is much more emphasized than before. If I would need to go with the one sentence.
Okay, thank you. And I think that we have to be conscious of our time. I want to also open the floor for Q&A. Anybody who wants to ask some questions from the audience, please do use Q&A button and ask the live questions to our expert speakers. I would like to read out loud one of the questions that we received, and this is in regards to the infrastructure investment by some of the largest private equity funds. Blackstone buying into the Italian highway. Will we see more of the activity in CEE from large funds and similar state-owned or previously not for sale businesses which now struggle due to COVID-19, like highways, energy, TMT? Adam, would you like to take on this question, please?
So I unmute myself. Yeah, so what we observe now since a couple of weeks is that we have a highest interest for infrastructure. We have more and more potential opportunities from the other advisory side. either involving PE funds or strategic investors in infrastructure, in renewables. We know that in most CEE countries, the financial shields and anti-crisis shields which were implemented also included part, an infrastructure part. So some huge funds will be invested during the next couple of years to help the recovery of our CEE economies. Renewables, for sure. I mean, we in most CEE, we have EU members, and we have to stick to the roadmap defined by European Union in terms of green energy, and here we see a high interest, yeah, from PE funds. Now the question is from where those funds will come. For sure, given the limitations, it will be maybe a little bit harder in some countries for funds coming from China to invest compared to CEE or Western ones. But more generally, yes, we can consider that more and more there will be such potential opportunities in energy, in infrastructure, and as far as TMT, yeah, IT and 5G implementation should be also a catalyzer for such ideals.
Okay, thank you. I am conscious on the time, and I think we have to bring this webinar to the close, but I want to give our expert speakers here the opportunity to give one very final remark. You know, what are your personal market expectations for the forthcoming 12 or 24 months, if in this time of uncertainty, you can actually summarize your expectations in a single statement or a single sentence, please?
If I may start, I would say that what we are expecting is that there will be a lots of consolidation of the market. I think that the market, again, you know, the business will go back as normal, probably in the period of 2 years. But what we are expecting is lots of transactions that will be consolidating the market, because in our region, especially, the quality of balance sheet is quite poor in companies. And what we expect is that some of the market players will actually are suffering from the crisis and will be probably taken over by the market leaders. So this is the prime focus we will have in the next 24 months.
Yeah, and I saw that there was a question regarding distressed opportunities. For sure, I mean, what we already observe is that we have also a higher interest from owners who are in the succession planning trend. Yeah, so COVID-19 might in some cases accelerate their willingness actually to sell, which could create quite interesting opportunities also for PE funds during the next couple of months.
Mm-hmm. Okay, thank you. And I'm afraid that, you know, that we'll need to bring this seminar to the close. And but by all means, we can continue our discussion at our social networks. So please feel free to find both Croatian Private Equity and Venture Capital Association at Facebook, Twitter, and LinkedIn. And I would like to thank our expert speakers and the panelists. I also want to mention that everybody who participated at today's discussion will receive the slides and will be able also to get in touch directly with the speakers. And I want to use this opportunity to actually say that this was our first and inaugural webinar in a series called Turning Crisis into an Opportunity, because I think that in every crisis there is an opportunity. And I just want to present some of the titles of our forthcoming series. We are going to have a range of topics, including the macroeconomics, the COVID-19 impact on the tourism industry. Again, some of the experts from private equity funds sharing their views, and then incorporating the sustainability financing, or the ESG, in your investment strategy. We are going to specifically focus on tech and startups, as well as the programs to support development of CEE private equity funds. Now, having said all of that, We are now, we are planning to have the rest of our webinars starting from September, most of them taking place on Thursdays at 4 p.m. Central and Eastern European Summer Time, with the exception of the very first one, which we are going to do jointly with TMA Croatia, another association. Now, once again, I would like to invite you to follow us on our social network, and please do continue the conversation on our social networks. And thank you so very much for being here with us today. If you have any questions, please do not hesitate to get in touch. Thank you very much, and thank you once again with the expert speakers, and it's been a real honor to have both Andrija and Adam here with me today. Thank you, everybody, and goodbye, and I see you in September. Thank you.
Thank you.
Thank you very much.
Bye-bye.
Bye.